Here's the brutal truth that will either save your trading career or expose why you're destined to join the 90% who fail. Retail traders don't lose money because they lack intelligence, market access, or sophisticated tools. They lose because they ask fundamentally wrong questions before placing trades, while amateurs frantically scan social media for hot tips, chase momentum stocks recommended by influencers, and jump between strategies seeking the Holy Grail. Professionals like Jesse Livermore built systematic mental filters that eliminated 95% of potential trades before risking a single dollar. The market's primary job is separating you from your money as efficiently as possible. Your job is making that separation as difficult as possible through disciplined thinking and emotional control. Jesse Livermore transformed a meager $5 stake into $100 million by 1929, making him one of America's wealthiest men. This wasn't luck, insider information, or some secret algorithm Wall Street didn't want you to know. It was pure discipline, combined with an understanding of market psychology. Livermore learned through painful losses in Boston's notorious bucket shops that small wins could quickly become devastating losses. Every amateur trader who has ever blown up an account can relate to his early struggles. The difference is that Livermore used those losses as expensive education, forging them into a systematic approach that would serve him for decades. The identity shift between amateur and professional thinking starts with the questions they ask. Amateurs approach trades asking, "How much money can I make on this?" They calculate potential profits, dream about what they'll buy with their winnings, and size positions based on greed rather than mathematics. Their mindset sees opportunity everywhere because it's driven by fear of missing out and the intoxicating possibility of easy money. Every market dip screams bargain to them. Every breakout above resistance whispers, "Buy me before it's too late." They chase momentum when stocks are already extended, fight major trends because they think they know better than institutional money, and size positions based on excitement rather than cold probability. Professionals approach the exact same opportunity asking completely different questions. How much can I lose? Where exactly will I be wrong? And why should I risk my capital right now instead of waiting for a better setup? This fundamental shift changes everything about how you interact with markets. The professional understands that preservation of capital is the foundation of all successful speculation. They know that your ability to stay in the game long enough to catch big moves depends entirely on not getting knocked out by a series of small losses that compound into account-destroying damage. Picture two traders analyzing the same stock after a 5% decline. The amateur sees a bargain and doubles down without a stop-loss, thinking, "It can't go lower." When it drops another 10%, he holds and hopes, eventually capitulating at the exact bottom. The professional waits, asking his systematic questions. No clear trend support, no entry. When the stock finally surges on heavy volume, clearing resistance with institutional participation, he buys a starter position with risk precisely defined and position size calculated mathematically from his stop level. Through his expensive bucket shop education, Livermore developed 4 simple but powerful questions that acted as his personal trading filter. These weren't complex mathematical algorithms requiring advanced degrees or sophisticated software. They were psychological checkpoints designed to force him to think like a surgeon approaching a delicate operation rather than a gambler rolling dice in Las Vegas. Each question served as a potential veto point that could kill a trade before it started. All 4 questions had to provide positive answers before he would commit maximum the position size to any opportunity. The genius of this system wasn't just in identifying winning trades but in avoiding losing ones. For every profitable trade that made newspaper headlines, there were dozens of potential trades that his filter system rejected, saving him from losses that could have wiped out his capital. In trading, avoiding losers is often more important than finding winners. If you risk 1% per trade and lose 5 times, you're down about 5%. One strong trend can repay that loss with substantial interest. But if you risk 10% per trade and lose 3 times, you're down 27% and need a 38% gain just to break even. By 1907, when financial panic gripped Wall Street and lesser traders were wiped out, these 4 questions helped Livermore make $3 million by systematically shorting the market collapse. His disciplined approach allowed him to profit while others panicked. In 1929, these same mental filters guided his legendary $100 million profit as the stock market crashed and the Great Depression began. But here's what most trading books completely miss. These questions protected him from countless losing trades that would have destroyed traders with less systematic thinking. His four-question filter created what modern traders would recognize as a comprehensive risk management system, but it went deeper than mathematics. It forced emotional distance from the market's daily noise, the constant stream of news, rumors, and price movements that seduce traders into impulsive decisions. Waiting became a position. Patience became a strategy. By requiring himself to answer four specific questions before every trade, Livermore created a buffer between market emotion and trading action. Today, you're going to discover these four timeless filters that have worked for over a century and continue to separate winning traders from losing ones in modern markets. They're not mystical secrets hidden in ancient texts or complex formulas requiring advanced mathematics. They're examples of disciplined thinking that forces you to approach markets with the cold logic of a professional rather than the hot emotions of an amateur. Master these four questions, and you'll transform from someone who trades on hope, tips, and gut feelings to someone who trades only when evidence strongly supports taking risk. The first question alone eliminates approximately 60% of amateur trading mistakes in under 30 seconds of analysis. It's so simple that most traders ignore it, yet so powerful that consistent application would save most retail accounts from destruction. This question forces you to align with forces bigger than yourself, rather than fighting them with individual opinions and biases. Ready to discover what this game-changing question is? Livermore's first question appears deceptively simple, yet it possesses the ruthless power to eliminate 60% of amateur trading mistakes in under 30 seconds. Is the market trend confirming my direction? This wasn't about predicting where markets should go based on fundamental analysis, economic forecasts, or personal opinions about valuation. This was about coldly observing where institutional money was actually flowing and aligning with those massive forces rather than opposing them with individual conviction. The distinction between prediction and confirmation separates professionals from amateurs more than any other single factor in trading success. The amateur trader treats every stock as existing in its own isolated universe, completely disconnected from broader market currents. They'll enthusiastically buy growth stocks during raging bear markets because the company reports strong earnings, or aggressively short momentum leaders during powerful bull runs because they believe valuations are stretched beyond reason. This approach resembles attempting to sail a small vessel directly against hurricane-force winds simply because you personally prefer calm weather. You might possess superior sailing skills, deep knowledge of your craft, and years of experience on the water. But when you continuously pit yourself against forces exponentially larger than your own capabilities, you're destined to capsize and sink. Jesse Livermore learned this brutal lesson through expensive experience in 1906, a period that fundamentally shaped his entire market philosophy for decades to come. He became convinced through his own meticulous analysis that Union Pacific Railroad was grossly overvalued at $160 per share. His fundamental research was thorough. His reasoning appeared sound, and his conviction was absolute. The railroad industry seemed stretched. The stock had run too far too fast, and every logical indicator suggested an imminent collapse, so he shorted Union Pacific heavily, betting his capital against what appeared to be an obvious bubble waiting to burst. There was just one catastrophic problem with his otherwise intelligent analysis. He was fighting a roaring bull market where institutional money was pouring into railroad stocks with tremendous force. Union Pacific didn't collapse as his careful analysis predicted. Instead, it climbed relentlessly higher, powered by massive institutional buying that dwarfed his individual position. The stock surged to $180, then pushed past $200, then continued even higher as pension funds and large speculators accumulated shares with seemingly unlimited capital. His $40,000 loss on this single trade, equivalent to approximately $1.2 million in today's purchasing power, represented far more than just financial damage. It delivered a devastating blow to his capital, his confidence, and his entire approach to market speculation. But more importantly, this expensive education taught him a permanent lesson that would guide every subsequent trading decision throughout his legendary career. Individual opinion means absolutely nothing when the major trend fundamentally disagrees with your position. The market doesn't care about your major trend, analysis, your logic, your conviction, or your personal financial situation. It only responds to the overwhelming balance of buying and selling pressure. And that balance is determined primarily by institutional money flows that dwarf retail participation. From that painful but formative experience forward, Livermore made the primary market trend his most trusted ally, rather than his most dangerous enemy. When the major trend was definitively bullish, confirmed by breadth expansion, volume patterns, and sector leadership, he focused exclusively on identifying long opportunities in the strongest stocks, showing relative strength. When the trend turned decisively bearish with institutional selling evident across multiple sectors, he concentrated entirely on short positions in the weakest names, breaking down from key support levels. He completely stopped trying to outsmart forces far bigger than himself and started working with them instead, harnessing their power rather than being crushed by their opposition. Consider two modern traders analyzing the same stock after a sharp 15% decline from recent highs. The amateur sees this pullback as an obvious bargain opportunity and immediately begins calculating how many shares he can afford. He ignores that the major market indices sit below falling 200-day moving averages. That market breadth shows 70% of stocks declining. That volume has been expanding on down days while contracting on bounce attempts. And that former sector leaders are breaking down from key support levels. He's rowing his small boat directly into the gale, convinced he can reach shore through superior effort and determination. The professional approaches the identical opportunity with Livermore's systematic protocol. First, he defines the major trend using key moving averages and pivotal points that have proven significant in previous market cycles. Are the major indices above or below their 200-day and 50-day moving averages? Are they making higher highs and higher lows, or lower highs and lower lows? Second, he checks market breadth by examining advanced decline lines and the percentage of stocks above key moving averages. Are 60% or more of individual stocks participating in the supposed trend direction? Or is leadership narrowing to just a handful of large-cap names? Third, he examines volume patterns with surgical precision. Does volume expand on moves in the direction of the primary trend and contract on counter-trend pullbacks? Strong volume confirms institutional conviction behind price movements, while light volume suggests hesitation or lack of serious money participation. Fourth, he assesses sector leadership by comparing relative strength lines of major industry groups against the broader market. Are former leaders confirming the overall trend by making new highs, or are they diverging by showing weakness while the indices continue higher? If any element of this analysis reveals that the major trend opposes his directional bias, the professional makes a binary decision. Either flip completely to align with institutional flows, or exercise patience and wait for clear evidence of trend change. Position size always starts at 0 when the market trend disagrees with intended direction. This approach recognizes that your cheapest stop loss is the trade you never enter, the position you never establish when fighting overwhelming institutional flows. Individual stocks can certainly fight broader trends temporarily, especially during earnings announcements or major company-specific news events. However, institutions control the major money flows that ultimately determine intermediate and long-term price direction across all market sectors. When pension funds, hedge funds, mutual funds, and sovereign wealth funds begin rotating billions of dollars in one direction, fighting that rotation with individual stock picks becomes financial suicide. These massive entities possess the capital, research resources, a long-term perspective that dictates the market's primary direction, creating currents far too powerful for retail traders to oppose successfully over time. The maxim that guided Livermore throughout his career perfectly captures this reality. Trade with the tide, not against the splash. You align your capital with the powerful, undeniable currents created by institutional money flows rather than fighting them with individual opinions about what should happen. This first question alone prevents the majority of amateur mistakes by forcing strict alignment with larger market forces before considering any individual trade opportunity. Your daily protocol must revolve around this fundamental question. Before analyzing any stock setup, before calculating position size, before identifying entry and exit points, You must first determine whether the major trend supports your intended direction. If institutional money is flowing against your bias, you have two disciplined choices: completely flip your directional approach to align with the trend, or exercise the patience to wait for clear evidence that trend conditions have changed in your favor. But confirming favorable trend direction represents only the beginning of systematic trade selection. Even during the most powerful bull markets, the majority of individual stocks fail to capitalize on supportive conditions, breaking down at critical moments when they should be breaking out with authority. How do you identify which specific stocks are truly positioned for explosive moves when broader market conditions are favorable? With favorable market trend confirmed, Livermore's second question eliminated pretenders from genuine opportunities with surgical precision. Is this stock at a true pivotal point with confirmation? This question demanded irrefutable proof rather than hopeful anticipation. It forced him to wait for evidence instead of acting on predictions, separating those who trade on facts from those who gamble on possibilities. Amateur traders consistently anticipate price movements rather than responding to them. They buy before breakouts occur, reasoning they'll secure better prices by entering early. They purchase on rumors, expecting profits when news eventually materializes. They enter positions based on promising chart patterns rather than patterns proven through decisive price action. This anticipatory approach leads to premature entries, stop-loss triggers during normal volatility, and the painful experience of being shaken out just before their thesis proves correct. Professional traders approach identical opportunities with completely different psychology. They willingly pay premium prices for concrete proof. Their thesis is playing out in real time. They understand confirmation beats prediction every single time because markets overflow with promising setups that ultimately fail. Paying an extra 2 to 3% for confirmation is insignificant compared to avoiding the 10–20% losses from anticipating moves that never materialize. This mindset shift from prediction to confirmation eliminates most losing trades before they damage capital. You must understand what makes a true pivotal point. These aren't arbitrary lines drawn by analysts or random support levels identified through wishful thinking. They're genuine battle zones where significant previous buying or selling created lasting emotional memory among participants. When stocks finally break through these critical levels with unmistakable authority, they signal the underlying balance of power has fundamentally changed, creating conditions for sustained directional moves. Consider Livermore's legendary 1929 campaign. He identified Radio Corporation of America, building a massive distribution pattern near $100. The pivotal point was crystal clear. A break below $85 would signal institutional selling overwhelming retail buying. For weeks, RCA churned between $85 and $95. Amateur traders bought every dip toward $85, hoping for bounces back toward $95. They couldn't tolerate uncertainty, acting on hope rather than evidence. Livermore demonstrated the patience of a master predator. He refused to anticipate the breakdown despite strong conviction about eventual direction. He understood being early produces identical results to being wrong. Position size remained zero while monitoring price action, volume patterns, and buying versus selling pressure character. On October 23rd, RCA finally provided the confirmation Livermore awaited. The stock broke decisively below $85 on massive volume, measuring 3 times daily average. The tape revealed relentless selling with no meaningful buying support. Most importantly, the breakdown showed immediate follow-through below the pivotal point with no hesitation or reversal attempts. That definitive confirmation triggered Livermore's substantial short position. He didn't guess or hope for further weakness. He responded to concrete evidence that supply overwhelmed demand at a critical level. RCA continued falling to $28 as the broader market collapsed, while amateurs who bought the obvious bargain at $90, $85, and lower suffered devastating losses. Livermore's disciplined confirmation approach generated millions from systematic execution. Your protocol must eliminate subjective interpretation. First, identify clear support or resistance levels tested at least 3 to 4 times over meaningful periods. Multiple touches validate levels as true battlegrounds, where supply and demand repeatedly clashed. Second, wait for decisive breaks accompanied by volume at least 150% above average. Heavy volume confirms institutional participation, driving movement, rather than temporary retail enthusiasm. Third, demand immediate follow-through, without hesitation or reversal attempts. Genuine breakouts show sustained directional pressure. False breakouts quickly reverse, as buyers or sellers defend violated levels. Fourth, check relative strength versus the broader disdains market. Ensure participation in or leadership of overall trends rather than lagging major indices. Fifth, for long positions, ensure no significant overhead supply within 5 to 10% that could cap upward movement. False breakouts display predictable characteristics. Light volume indicates lack of institutional participation. Weak follow-through quickly reverses toward pivotal points as defenders emerge. They often occur during low participation periods when retail dominates rather than institutional flows. Genuine breakouts demonstrate conviction through unmistakable signs. Heavy volume confirms serious money drives movement. Immediate continuation shows sustained institutional interest rather than temporary enthusiasm. Broad participation across related stocks indicates widespread rotation rather than isolated events. These breakouts produce sustained moves, justifying premium confirmation prices. The maxim guiding Livermore's approach perfectly captures required mindset. The stock must prove itself before you believe it. This prevents costly mistakes of falling in love with promising setups that disappoint. It forces waiting for evidence rather than acting on hope, anticipation, or personal conviction about what should happen. Modern traders implement this exact approach using current tools. Before entering positions, identify specific pivotal points that would confirm directional thesis. Define exact volume and follow-through characteristics constituting valid confirmation. Then exercise patience to wait for those conditions rather than anticipating through premature entry. This systematic confirmation approach eliminates most losing trades by ensuring action only when market evidence strongly supports thesis. It transforms trading from guesswork into evidence-based decisions, where positions are supported by objective proof rather than subjective hope. But identifying perfect setups with proper confirmation represents only half the equation. Without precise risk management and mathematical position size calculation, even perfectly timed entries can destroy accounts through excessive risk-taking or inadequate protection. Before Livermore placed any order, committed any capital, or exposed himself to market risk, he answered his third question with mathematical precision that separated professionals from gamblers more decisively than any other factor. What is my exact risk and proper position size? This question forced him to confront an uncomfortable truth that amateurs consistently ignore. Profits are uncertain and unpredictable, but losses can be defined in advance with mathematical precision. If you can define your maximum downside before entering any trade, you can survive long enough to capture the upside when major trends develop. If you cannot, the market will perform surgery on your account without anesthesia. Amateur traders size positions through pure emotion and excitement. They buy 1,000 shares because that round number feels right, or because it matches what they purchased last time. Their stop loss remains deliberately fuzzy, maybe 10% below entry, perhaps 20% if they're feeling optimistic, or the catastrophic, "I'll know when I see it" approach that guarantees eventual disaster. When trades move against them, they freeze like deer in headlights. Fear paralyzes rational thinking. They hope, pray, and often average down, throwing good money after bad while convincing themselves they're getting bargains. The result is predictably devastating. Small, manageable cuts rapidly transform into account-destroying amputations that can take months or years to recover from. Livermore completely inverted this emotionally driven approach through systematic risk management that prioritized capital preservation above all other considerations. He located his exact pain point first, asking himself where he would be definitively wrong based on price action, not personal opinion. Where would his thesis be completely invalidated regardless of hope or conviction? How much capital could he afford to lose on this single speculation without compromising his ability to participate in future opportunities? Only after answering these fundamental questions with mathematical precision would he calculate appropriate position size for the identified risk level. Consider his legendary 1924 wheat speculation that demonstrates this systematic approach in action. Through careful analysis of supply-demand dynamics, seasonal patterns, and technical formations, Livermore identified a critical pivotal point at $1.20 per bushel. His analysis suggested wheat could rally significantly if it cleared this resistance with authority. However, he also recognized that failure to hold above $1.20 would invalidate his bullish thesis completely. His invalidation point was crystal clear. $1.15 per bushel represented the level where his analysis would be proven wrong beyond reasonable doubt. This created a precise 5-cent risk per bushel on any long position established above $1.20. With his total account value at $50,000, Livermore adhered to his strict rule of risking exactly 1% of total capital on any single trade. This meant a maximum risk of $500 on the wheat speculation. The mathematics became beautifully simple and removed all emotional interference. Position size equals total risk divided by risk per unit, or $500 divided by $0.05 equals 10,000 bushels maximum. When wheat finally broke through $1.20 on heavy volume, providing the confirmation his second question demanded, Livermore bought exactly 10,000 bushels with his stop-loss predetermined at $1.15. No emotions, no second-guessing, no adjustments based on how the trade felt after entry. The trade initially tested his resolve by dipping to $1.17, just 2 cents above his stop-loss level. Amateur traders would have panicked, closed the position to preserve capital, or moved stops lower to avoid being stopped out too early. Livermore held firm because his mathematical approach accounted for normal volatility around pivotal points. His position size was calculated to handle this exact scenario without emotional stress. Wheat subsequently surged to $1.45, generating substantial profits that more than justified the systematic risk management approach. Your protocol must eliminate all emotional position size decisions through mathematical calculation. First, place stops exactly where your thesis is definitively invalidated, not where losses hurt less emotionally. The market doesn't care about your pain tolerance, it only responds to supply and demand at specific price levels. Second, risk between 0.5% and 1% of total capital per trade, with newer traders using 0.5% until they develop consistent profitability. Third, calculate position size using this formula: total risk amount divided by entry price, stop-loss price, equals maximum position size. If this calculation produces a position size too small to be meaningful, pass the trade entirely rather than increasing risk beyond systematic limits. Fourth, never average down on losing positions under any circumstances. Pyramiding only occurs after trades show profits and provide fresh confirmation of thesis validity. Fifth, maintain maximum 3 to 4% total portfolio heat across all positions combined. This aggregate risk management prevents the common amateur mistake of having multiple correlated positions that fail simultaneously during market stress. Remember that 5 different technology stocks represent one trade in disguise, not 5 separate risks. This mathematical discipline enabled Livermore to be wrong approximately 60% of the time, while still generating enormous fortunes throughout his career. His systematic approach ensured winning trades were multiples of losing trades because he cut losses quickly while letting profits run through major trending moves. The maxim that guided his risk management perfectly captures this philosophy. Small losses keep you in the game long, enough to catch the big winners. If you risk 1% per trade, you can lose 20 consecutive trades and retain 82% of your capital. But if you risk 10% per trade, just 3 losses destroy 27% of your account, requiring 38% gains just to break even. This systematic approach transforms trading from emotional gambling into calculated business decisions where you know exactly how much you're risking before entering any position. You know precisely where you'll exit if wrong, and you size positions mathematically rather than emotionally. But systematic risk management represents only the foundation for trading success. Knowing when and how to add to winning positions while exercising the patience to let major trends unfold separates competent traders from legendary speculators who capture truly life-changing moves. Livermore's fourth and final question addressed the psychological battleground where most traders sabotage their own success. How will I add to winners and exercise patience? This question separated those who made modest profits from those who captured life-changing fortunes. It forced confrontation with two uncomfortable truths that destroy most trading careers: the natural tendency to take profits too quickly while holding losses too long, and the inability to sit still when positioned correctly in major trending moves. Amateur traders celebrate paper profits like lottery winners, immediately calculating what they'll buy with anticipated gains. This premature celebration leads to two catastrophic behaviors. They either grab profits far too quickly, turning potentially massive winners into small gains that barely cover inevitable losses, or they commit the even more destructive sin of adding to losing positions to average down. They convince themselves they're getting bargains when stocks decline after purchase, doubling down on weakness instead of strength. The result is predictably devastating. They transform winning trades into break-even disappointments, while turning small losses into account-destroying disasters. Livermore inverted this natural but destructive psychology through systematic pyramiding that only added to positions showing him profits with fresh market confirmation. His approach was surgical in precision and counterintuitive in execution. He started with a base position calculated through his third question's mathematical risk management. If the market confirmed his thesis by moving favorably and generating profits, he would add a smaller amount at higher prices for longs or lower prices for shorts. If that addition also proved profitable with continued confirmation, he might add an even smaller third position at still more favorable prices. Each addition required fresh evidence that his thesis was playing out correctly. He never bought weakness hoping for bounces, never averaged down on declining positions, and never added to positions moving against him regardless of conviction about eventual direction. Watch this systematic pyramiding strategy unfold in his legendary 1907 short campaign against Union Pacific Railroad. Starting with a modest short position at $165 per share, Livermore exercised the patience of a master hunter waiting for perfect conditions. When Union Pacific finally broke key support at $155 on heavy volume, showing him a $10 profit per share, and confirming institutional selling was overwhelming retail buying, he added 50% of his original position size at $153. This wasn't gambling or hope, it was responding to concrete evidence his thesis was correct. As the panic accelerated and widespread selling pressure drove Union Pacific down to $145, Livermore added a final 30% of his original position at $142. His pyramided position now consisted of three layers: the original base at $165, the first edition at $153, and the final edition at $142. Each edition was smaller than the previous, creating an inverted pyramid structure that maximized profits if the trend continued while limiting additional risk if conditions changed. His complete position rode Union Pacific down to $85 during the financial panic, generating over $1 million in profits, while most traders suffered devastating losses. But pyramiding represented only half of Livermore's genius. The other half was patience, what he called sitting tight. The ability to endure minor pullbacks, ignore daily market noise, and allow major trends to unfold over weeks or months without interference. Once positioned correctly with the trend confirmed and pyramiding complete, Livermore would resist every temptation to trade around his position. He understood that major moves happen in spurts, separated by periods of consolidation designed to shake out weak holders. His most famous observation captures this philosophy perfectly. "It is never my thinking that makes the big money for me. It is always my sitting." This wasn't laziness or inaction, it was disciplined recognition that most profitable trading activity involves waiting for the right conditions rather than constantly buying and selling. Your protocol for question 4 must address both pyramiding and patience with specific rules. First, add only to profitable positions showing fresh confirmation through price action and volume. Never add to losing positions regardless of conviction or fundamental analysis. Second, make each addition progressively smaller. If your base position represents 100% of planned size, the first addition should be 50%, and the second addition 30% maximum. Third, never add below your last purchase price for long positions, or above your last sale price for short positions. Fourth, raise stop-loss levels to protect accumulated profits as positions grow, ensuring you can never lose money on successful pyramiding attempts. Fifth, Exercise patience by allowing major trends to unfold over weeks or months without interference. Resist the temptation to trade around core positions or take profits during normal pullbacks. Sixth, exit only when market character changes through heavy volume reversals, decisive pivotal point breaks, or clear trend deterioration. The maxim that guided Livermore's approach reveals a counterintuitive truth. Sitting tight is the hardest thing in trading, but it pays the most. This recognizes that doing nothing is often your most profitable action when positioned correctly. Waiting becomes a position in itself. Patience transforms from passive inaction into active strategy. Amateur traders constantly seek reasons to trade, viewing activity as progress and inaction as missed opportunity. Professional traders like Livermore sought reasons not to trade, understanding that most market activity represents noise rather than genuine opportunity. His 4 questions created multiple veto points where any single question could eliminate a trade, ensuring only the highest probability setups, with favorable risk-reward characteristics, received maximum capital allocation. This systematic approach explains how Livermore could be wrong more often than right while still generating enormous fortunes throughout his career. His pyramiding strategy maximized profits from correct calls, while his patience allowed major trends to compound gains over extended periods, separating competent traders from those who captured truly life-changing moves. These 4 questions weren't isolated checkpoints operating independently. They formed an integrated system where each built upon the last, creating an unbreakable filter for trading decisions. Think of them as interlocking gears in a precision machine. Miss one gear and the entire mechanism jams. This systematic integration represents where Livermore's true genius emerged, not in the individual components themselves, but in their synthesis into a comprehensive approach that addressed every aspect of successful speculation, from market analysis through position management. Watch how all 4 questions aligned with mathematical precision in his legendary 1929 campaign that netted him $100 million, while most traders suffered devastating losses. Question 1 demanded trend confirmation. The major market trend was shifting decisively from bullish to bearish, with unmistakable institutional selling. Market breadth was deteriorating rapidly as fewer stocks participated in rallies. Former leadership was failing dramatically as previous winners broke down from key support levels. Volume patterns clearly showed expansion on declines and contraction on bounces, confirming distribution rather than accumulation across all major sectors. Question 2 required pivotal point confirmation. Multiple stocks across various industries were showing massive distribution patterns at key resistance levels. Radio Corporation of America, trading near $100, had built a clear distribution pattern with the pivotal point at $85. For weeks, the stock churned between $85 and $95, while amateurs bought every dip, hoping for bounces. When RCA finally broke $85 on October 23rd with volume 3 times the daily average, showing relentless selling with no buying support, Livermore had his confirmation. This wasn't anticipation, this was responding to undeniable evidence that institutional money was fleeing. Question 3 demanded precise risk management. Risk was mathematically defined at recent highs, with position size calculated to risk exactly 1% per individual trade. For his RCA short, the invalidation point was clear at $95, creating an exact $10 risk per share. With his systematic approach, he could short thousands of shares while knowing precisely his maximum loss if wrong. This mathematical precision allowed him to commit massive capital safely across multiple positions. Question 4 required systematic profit management. As positions moved into profit territory, he pyramided systematically with progressively smaller additions while exercising enormous patience as the crash unfolded over months. His RCA position rode from $85 to $28, generating millions as he added to strength and held through temporary bounces that shook out weaker hands. All 4 questions provided unmistakable green lights simultaneously. Livermore went heavily short across multiple positions and held through the entire market collapse with unwavering discipline. But here's the crucial point that separates systematic traders from gamblers. If any single question had flashed red, he would have either passed entirely or dramatically reduced his position size regardless of personal conviction about market direction. Amateur traders approach markets seeking reasons to trade, viewing inactivity as missed opportunity and constant position changes as productive work. They scan for setups, tips, or technical patterns that might generate profits. Their default mode is action because they equate trading activity with progress toward financial goals. Professional traders like Livermore approached markets seeking reasons not to trade, understanding that most apparent opportunities represent traps designed to separate them from their capital. These 4 questions created multiple veto points throughout Livermore's decision-making process. Each question possessed the power to kill a trade completely before capital was risked. Question 1 could eliminate opportunities if trend conditions were unfavorable. Question 2 could reject setups lacking proper confirmation at pivotal points. Question 3 could prevent trades where risk couldn't be precisely defined. Question 4 could eliminate opportunities where profit management protocols couldn't be systematically applied. But all 4 questions had to align positively for maximum commitment of capital and attention. This systematic approach explains why Livermore could go months without making significant trades, then strike with devastating effectiveness when conditions aligned perfectly. He wasn't lazy or indecisive, he was selective to an extreme degree that most traders cannot psychologically tolerate. His patience represented active strategy rather than passive inaction. Waiting became a position in itself, preserving capital for those rare moments when all conditions aligned. The beauty of Livermore's system lies in its elegant simplicity rather than complex sophistication. 4 questions. No exotic indicators requiring advanced mathematics. No complicated algorithms demanding constant recalibration. Just disciplined thinking that forced emotional distance from the market's daily noise. Fear-mongering headlines, and tip sheet recommendations that seduce amateur traders into impulsive decisions. Each question addressed a different aspect of trading psychology. Trend following to align with institutional flows, pattern recognition to identify genuine opportunities, risk management to preserve capital, and patience to maximize profits from correct decisions. The complete system operates through logical sequence. Market first. Is the trend confirming my intended direction? Setup second. Is this stock at a true pivotal point with confirmation? Risk third. What is my exact risk and proper position size? Management fourth. How will I add to winners and exercise patience? This sequence creates a filter that expands when markets provide genuine opportunities and contracts when they don't. Modern traders can implement this exact system today using current tools and markets. Before every trade consideration, ask Livermore's 4 questions in precise order. If you cannot answer all 4 questions positively with specific, measurable criteria, either pass the opportunity entirely or reduce risk dramatically below normal levels. This systematic approach transforms trading from emotional gambling into business decisions based on evidence rather than hope. The final maxims that guided Livermore throughout his career encapsulate the system's core principles. Cut losses fast. Let winners run. Waiting is a position. Patience is a strategy. Market is never wrong. Opinions often are. Remember the ultimate truth. Sometimes, the best trade is the one you don't make. Cut losses fast. Size positions small. Wait for market confirmation at pivotal points. Add only to winners. Exercise patience. Own your process. Waiting is a position. If you've learned how these 4 questions create an unbreakable trading filter, our next lesson on reading the tape like Livermore will teach you to spot institutional accumulation versus distribution in real time, the skill that separated him from every other trader of his era.